Hello, everybody, and welcome to Wall Street Hackers, the most popular show on LinkedIn's Pod TV network last week. And why it's so popular, I don't know. Can't answer it, but a lot of people tuned in to listen to it. Maybe it's because of the stock market. People want to know where it's going to go. And with that, we're going to bring in Peter Bennett, the hacker himself, who's a graduate of UCLA, where he received his degree in economics, his law degree from the University of Miami, and his master's in business administration from NYU. Then he spent 17 years, almost 2 decades, working in New York City on Wall Street, learning the ropes about investments, and he's going to bring you some highlights of what we should look at this week, including the markets, quotes of the week. Of course, the thing is, we're going to look at Peter's picks and stories of the week, and a panel discussion. So with that, we're going to do it all in 30 minutes or less. No other than Peter Bennett, the head of Wall Street Hackers, and congratulations being the #1 show on the Pod TV network on LinkedIn last week, in case you didn't know.
Oh, hang on 1 second. I'm going to run out of power on my computer.
Oh, well, you definitely don't want to run out of power on your computer.
So, Nick, man, you don't know. I mean, look, we've been on for years. I don't remember now, 3 years, 3.5 years. I've been making amazing political and financial predictions, generally right on everything. I mean, I just think of like when the Ukraine wars came out so many times. I said, you know, everybody's saying it's going to be a week or two and it could be years. I'm just giving you an example, but I made a lot of right political predictions. And financially, I've been advocating for a lot of stocks that have done very well. I mean, look at my #1 pick for years now, MPLX. I loved it at 12. I loved it at 25. I loved it at 40. I loved it at 50. I was doing it a few weeks ago. It was at 56 today. Still has an 8% dividend. And this week, I'm going to discuss something that I like, not as much, but it's kind of similar in a way. And I haven't even found another pipeline I like. So welcome to Wall Street Hackers audience, December 9th, 2026. You can get your new episode most weeks at 6 p.m. Eastern Standard Time, depending on your distribution channel. That said, we're taking a Christmas break for the season, and we'll be back Tuesday, January 6th, starting at 6 p.m. again, depending on your distribution channel, Eastern Standard Time. I figure Yellowstone can take 6 months. I can take a few weeks. We start with the market report, and this week we're doing a different market report. We're going to do a short-term report because the actual panel question will be, where will the market be going in the medium to long term? So selected quotes of the week. Of course, these are ones that I kind of agree with, and they are selections from different articles. First from Samuel Smith, Seeking Alpha, December 3rd, 2025. There is a major disconnect forming between the market and the economic reality. While the S&P 500 is trading near all-time highs, key underlying economic data seems to be indicating a major market disconnect. The U.S. economy appears to be enduring a stagflationary slowdown, as evidenced by weak production and persistent inflation. The latest evidence of this came from ISM Manufacturing PMI in November, which fell to 48 from 0.2 from 48.7 in October, marking the 9th straight month of manufacturing sector contraction. Despite this weakening of industrial activity, inflation remains elevated, with the price index at 58.5, which points directly to a stagflationary environment emerging. And we'll have comments on these later. The second article is from Damir Tokic, which I can never pronounce, Tokic, also on Seeking Alpha. The S&P 500 outlook for 26 recessionary bear market with a bubble burst. And by the way, this is just their opinions. I'm not a macro investor. I look for the right companies that should do well in any environment. So he says the S&P 500 is entering 2026 trading at a bubble-like valuation, while ADP is pointing to job losses. this is true. There's been some losses lately. That suggests that investors can expect a recessionary bear market with a bubble burst in 2026. The key decisive factor in which the trillions of dollars of committed direct foreign investment might prevent a recession. So that's a really big thing. I'll comment on that later. ADP showed job losses in 4 of the last 6 months. These are not good trends. Other factors include deglobalization, which is going to continue to accelerate in 2026. And the AI bubble could burst, he says. So summarizing these two, there are many short-term risks, not to mention long-term risks in the market. There's all kind of things that are potential risks. Again, not affecting exactly my environment investments, but more and recommendations, but affecting what strategies should be implemented. So according to what we're hearing from these people, and I think it's showing it with manufacturing slowing down month after month and inflation still too high, it is very possible that we do get stagflation. The consumer has been under more and more stress for years. Inflation was exorbitant during the Biden years. I would add, the Democrats are saying, oh, Trump is supposed to make it affordable. He's been in office, 10 months, whatever. It takes time to even get policies implemented in their legs. And most of his policies are pro-growth, and inflation has been coming down. But yes, things are affordable because for 4 years, inflation went through the roof under Biden. And again, there's other issues causing that, which like 50 years of debt buildup, which had nothing to do with Trump. Not that I think Trump is perfect. A possible AI slowdown is another concern because there's 2 big things here. 1 or 3, actually. Again, this will be in the long-term discussion too. But 1, there's the fact that many companies are not getting a return on AI. I think that in the long run and medium term, AI is going to have a big impact. But that raises the second issue of AI replacing jobs. How many jobs are going to be replaced? It could be massive. What was it? Bill Gates' famous expression was people overestimate the change in 1 year and underestimate it in 10. And that is really true when it comes to AI. It is advancing. I see it advancing. I see it getting better. And I've had some personal experience with AI where I said, wow, that was pretty impressive. Although I see a lot of hallucinations and other issues and where it's useless. But it's coming along. But still, the massive money that's been going in probably going to slow down. And the other thing is there's a very hidden issue, which I discussed last week, which is the depreciation. So a lot of these tech companies, I don't know which ones because I haven't studied every one, but a lot of these companies are depreciating their chips at 4 to 5 year rates. But in reality, it's probably 2 to 3 year rates because of burnout. So that artificially increases the earnings of a lot of these companies. So AI replacing jobs and AI depreciation could be an issue. Again, bottom line, this is a dangerous, let's call, or a possibly very dangerous short-term and long-term macro environment. And it's hard to pick winners, but I believe disclosures in the investment section that we still have some good opportunities, but they're really hard to find. It used to be you could throw a dartboard, but that was during the prior decades when everything went up almost, and things were, better for different reasons. So next section, why President Trump should, or somebody in the White House should give me a call. They really should give me a call. I can really help in so many issues, but I'd focus on the fact that I know so much about the healthcare industry because I'm indirectly related to it for decades, but I also have the legal background, the tax background, and the financial background. And it doesn't seem like Washington understands a lot about healthcare. I mean, you think they would. They sort of do, but if I ever spoke to Washington today, which is debating right now whether to give subsidies or not, I'd have them moving in 5 minutes because, yes, we should not give what the Democrats want, illegal aliens, money. But the other side is the Republicans shouldn't be bringing abortion into the issue at all. But the other thing is this idea that even President Trump was advocating of healthcare reimbursements, HSA reimbursements, instead of it would just decimate the whole system. And not as, so Obamacare has its big issues. I said years ago it should never have been passed. They could have fixed the whole system. So give me a call if you want. I'll help for free. Okay. Investment of the week. First discussions. Wall Street Hackers is for entertainment only. These are only our opinions. There is no guarantee on any of our suggestions because there's no guarantee on any suggestions pretty much unless you hold them fixed income like a CD to maturity. Consult your financial advisor. So this week, an interesting pick, Western Midstream Partners. We have a 4% allocation. It's a pretty big allocation for us because we're cautious these days. So it's a lot similar to MPLX, which is a very massive allocation. And as a matter of fact, I bought a little more today, if you can believe it, Nick, at 56, but very small amount because it's a large percentage of my portfolio in terms of where I'm keeping it that way. Anyway, because again, I've done many shows on that, but their cash flow, I estimated about 18% or whatever, and they keep increasing their dividends at 10 to 12% rates, and they're still paying 8%. Anyway, so Wes is a really interesting company, and I've been looking for another pipeline for a long time. Wes owns and develops midstream assets engaged in gathering and transporting natural gas and crude oils, and also they've been moving more and more into water processing assets. Those are used, for fracking and removing water during the process of energy exploration. So West is an MLP, first of all, which is very beneficial in many ways for U.S. investors, MLPs in general. They offer return of capital, depreciation, and depletion. So a lot of times it's tax-free income, basically. But there are a few disadvantages. One, it's really, if you hold large amounts, moderate amounts in an IRA or 401k qualified plans, you don't want to do that because you have something called UBTI. It's an extra tax. So they really generally in large amounts or medium amounts should be held outside a 401k or IRA. Plus, some people complain about the extra expense of a K1. But you know what? I'll pay $100 to my account, $200 to an account to get huge tax benefits and a great investment any day. So what I like about West is, first of all, a 9.3% distribution, which is tax advantage. That's even higher than MPLX. It has a very healthy dividend history. I haven't confirmed this, but I believe I was looking at something that said roughly 10% annually. They've been growing their dividends for the last decade or two. I know it's been a good dividend history, but I haven't confirmed that, but I know it's really healthy. You start with a 9% dividend, and even if they increase it to 5%, heck, if it's tax advantage, I'll take a 9% and it never increases. But I believe they'll probably increase at least 3 or 4% this May, and there's a good chance. In terms of cash flow, I estimate, because they did an acquisition, so it's a little hard to get their cash flow exactly, a water-based acquisition, but I estimate it's probably a 12% cash flow yield. So basically, they're bringing in 12%, they're paying 9%, so that gives them about 3% for growth and reinvestment. And growth, any growth on a 9% yield is not bad. Another thing I like about them is it's primarily natural gas. Now, I prefer oil in the next 5 years, whatever, and MPLX is more oil-based. But what I like about it kind of is it's a piece that fits with MPLX because natural gas and oil, MPLX isn't that much natural gas. So they kind of go hand in hand. Of course, many are forecasting massive needs for natural gas because of data centers. So they're just supplying mainly the transportation and some of the gathering. But the bottom line is, I believe that there's going to be massive energy needs, and a lot of people agree, for the United States because of data centers, and just more needs for so many reasons, but especially data centers. Giant forecast. I think it was like 30% more by 2030. And so there's going to be a lot of demand pull. People are going to still need to heat their homes. People are still need to drive. This is in the energy sector that many times outperforms everything else. It's an excellent, but again, I wouldn't put too big in there. It's a crazy market, and diversification is important, but it's a very good diversifier if you want another high yield and potential growth investment. So panel question of the week, we'll bring in Nick. Nick, are you there? There you go.
I have to hit the right button, so that's all.
You're a little echoey, but I don't know if we can help that. Maybe move your microphone or something. I don't know. Whatever you want to do. Okay. So I'll go through the panel question first. You can work on that. Where is the market going in the medium and long term? Footnote. Nobody knows. There's something. I wasn't going to mention this, but in MBA school, you learn about random walks. It's very hard to predict the market in the short and long run. A lot of external factors affect it. But okay, background. May you live in interesting times is an ironic English expression. It's not Chinese, by the way. I've always thought it was Chinese, but when I looked it up, it says it's actually just English. It makes more sense. We live in a fast-changing world, obviously, because of both tech, innovation, and also because we're in the information age. This is a new age, so there's so much information out there. From an investor standpoint, there are a lot of factors that present both challenges and opportunities. So here are some of the forces that somebody has to look at all the pieces of this puzzle, including you, Nixon, and figure out good, bad, medium. I've got my opinion, but nobody knows for sure how these gigantic forces are going to affect everything. First of all, the massive U.S. debt, which we talk about on every show because nobody else seems to talk about it at all. Almost. They talk about 38 trillion. When we say, no, it's 125 trillion, and they're worried about the 38. So we get 125 trillion by adding the unfunded obligations of Social Security and Medicare. And these funds are running out in 2033. The clock is ticking. And when they hit that, that's going to be disruptive right there because all of a sudden there's nothing to get out of there and it's going to require massive money printing probably. But it's not just that, it's the world. So you say, oh, I'll go overseas, invest there. Well, I've looked at countries around the world in different continents, a lot of countries, and basically they have aging populations, underfunded retirement plans, similar to the United States in terms of percentage. Actually, sometimes it's remarkable. It's like almost the same percentage of underfunding. But the thing is, they're offering mostly free and sometimes free healthcare for aging populations. And I'm guessing they may not have put away, a lot of these countries have put away anything for this rising unfunded obligation. But that could be very disruptive to say the least. Factor two, or you could call that 1A and 1B before, AI. This presents amazing opportunities for companies. One reason I like Amazon, because I think they'll definitely be able to exploit it. But there's a few factors. As it improves, how many jobs it's going to take away? Everybody who reads a lot would know that there's so many jobs that might be threatened by AI. So, okay, great. You're improving companies' efficiency, but is everybody going to be on the government dole? And that's not going to be a very good income for people. So that could be very disruptive in the short run. Another factor is aging demographics themselves, which are not good for investing for two reasons. One, as people age, they tend to, until they're 50, they tend to put away money for retirement. As they get over 50, they tend to spend their money. Makes sense, right? They have to. People save for retirement and then they spend in retirement. So the thing is, we have a lot of the wealth and aging population in aging populations. So if they're pulling out money, that could cause stresses on the economy. But also, where's the money going? A lot of more and more money is going to healthcare, as we discussed before. So healthcare is a great industry. It does create some innovation. It does pay people well. But here's the problem. It's not really productive in terms of creating new assets. It's not like a factory. It's not a great wealth creator for a nation, I believe. I think it's more of a maintenance thing. Another factor, which we've discussed before, obviously, is the market itself, which is near high historic valuations. Pretty much everybody agrees on that based on ratios. And finally, we have several underlying cracks in the economy now, including a commercial real estate market that has been under stress for years and is barely improving. And that could cause a lot of financial disruption itself. Basically, empty offices and a lot of these office buildings have debt that's going to come due, and it's going to be very hard to refinance. So those are some of the fun things that are going on in the economy. Nick, what is your prediction? Where's the market going in the medium and long term?
Medium term, we might be doing okay, Peter. Long term, you have the systemic problem that you brought up, which will take place around the year 2033, which isn't that far away from now. And that is, what are they going to do about Medicare, Social Security, and the national debt? In other words, this $38 trillion debt isn't going away. But that's not the real problem. Let's say you handle the debt. How are you going to handle Social Security and Medicare busting out in 2033? Now, here's the way it looks like it's going to handle. Social Security, everybody's paychecks going to be reduced 24%. So if you're relying on Social Security, you're going to be in deep trouble. Medicare, forget a care, okay, because you're not going to be able to get it. There'll be a very small amount of things that are available under Medicare, and the rest of them you have to pay equal for. So these systems are systemically in trouble. Congress is not addressing it. The president's ignoring it. And yes, the Pod TV brings it up over and over again. Dave Walker was in Congress last week testifying about this, and he was on our show earlier this week. And he goes, I testified, I went through this stuff, and he goes, after I was done, all they did is the Republicans and Democrats pointed fingers at each other and blamed each other. They weren't looking to solve the problem. They were just looking to create political points. See, that's not going to solve the problem. So we have a very serious problem in the United States because we have a group of people who don't want to solve a problem, even if it's addressed to them, which will create a calamity similar to what we had in the Depression of the 1930s, except this will be in the 2030s. So I think short term you're going to be okay. But when you hit 2030, I think you better have your money parked in safe places.
Well, I guess question one is what is to follow up what, and then I have a bunch of comments about what you said, whatever, but what is, quote, safe? Where do you park your money? It's not that easy, Nick, because I believe in a diversified portfolio, some gold, some, NVLX, some other dividend producers, some treasuries, but nothing is safe necessarily because there's so many factors here. But let me make a few comments first. First of all, I'm not quite as worried about Social Security. There's not going to be a 24% cut because there are fixes. They won't fix the whole thing, but for instance, they should already raise the payroll tax. Why not have people making $100 million pay 2.5% on their income or $1 billion? That alone would help things. Plus, there are other fixes in Social Security. That's the easier one to fix. The real problem is Medicare. But even on Medicare, by the way, it won't be like, oh, you have no Medicare. What will happen, and I see this now based on your comments better than ever. I think I have an insight here. But basically, what will happen is they'll have to raise the deductibles. Now, right now, a person who's over 65 might have a deductible if they get a supplement, a traditional supplement, maybe for $250, $300, somewhere in there, of around maybe an annual deductible of $257 and maybe $20 to see a doctor as an example. Now, if you're under 65, you might have a $9,000 deductible or a $7,000 out of pocket, actually, but it's the same thing. So what's going to happen more than ever is, before I even get into my comments, I'm seeing it now. It's going to be stresses on the economy because they're going to have to raise the deductibles. And all of a sudden, older people are maybe, depending on income, whatever, going to have to pay $1,000, $2,000. But a lot of older people aren't prepared for these kind of costs. And that's going to cause a lot of stress on the economy too. So, and I don't know how much they can raise it, but in the end, that means money printing. So here's my comments. And the first thing, in the long run, I am optimistic because societies tend to advance. Technologies have a lot of improvements. They tend to advance financially and technologically, but change can be very disruptive. And we're going through a big period of change. Number two, with debt kicked down the road, President Trump's pro-growth policies could help a bit. I think he's saying they'll help enough, and I don't fault him for saying this. We need pro-growth policies. We have to grow our way out of this massive debt. AR will help growth in some ways and maybe hurt in others. But there are also a lot of other issues. But one is the Democrats. They may get the House or the Senate, next period, next midterms, and they will just cause more problems to President Trump's pro-growth policies. Not to mention, maybe we'll get a Democrat president in 4 years or 8 years, because you never know how people will vote because of the problems. But President Trump inherited a nightmare scenario where they've been kicking the can 50 years of road, not to mention Biden's inflation. And everybody's like, oh, you need to fix it in a month, 2 months. He's extremely active, and most of his economic policies are very good. I do criticize sometimes his mouth. Sorry, Mr. President, but sometimes you should be a little more careful, or phrase things a little better. Let's put it that way. But mostly on policy, excellent, policies for growth, and that might help. Now, why do I worry about the Democrats? Besides the fact that they believe in, many of them are now moving towards socialism and communism, which is a total failure for thousands of years. As a perfect example, you mentioned David Walker, is the Republican House sent over a bill to the Senate to do a fiscal stability commission to look at some of these issues. And David Walker may or may not be involved in that, but he might be one of the people on that committee. But either way, so Schumer wouldn't even, he vetoes it. He won't even let there be a commission to look at the issues, because it's all politics all the time. And don't worry about anything else, kick down the can. Obviously, I'm not a big fan of the Democratic economic policies and a couple others. I just heard on the radio 5 minutes ago before the show, a Minnesota congresswoman, I don't know if she was probably a senator, it probably maybe Claude Butcher, but I don't want to say it wasn't a House member, but somebody from Minnesota. She said, all of President Trump's policies have hurt affordability. That's totally ridiculous. Either I don't know if she's totally ignorant or if she's political, but that's so ridiculous. Almost everything's helping affordability. Energy policies are bringing down gas prices. But that said, his tariffs is the one thing you could argue about, the only thing, not all of his policies, but the tariffs are necessary because other countries have been ripping us off for years, and we need to bring back manufacturing to the United States to create jobs. And so we're not dependent on other countries, especially for things like medicine, kind of important. So the tariffs are very important. Knock on wood that I don't think the Supreme Court is going to totally veto them. But so the bottom line is, this is a time for investors to be very careful and selective, although it is always important, and very defensive in choosing your companies. You want to have companies with very large cash flows that can survive a likely stagflationary environment, probably, or any environment that will thrive every well. If you look at the predictions of JP Morgan, Schwab, and Goldman Sachs, they all forecasted lower returns overall for the markets or the market in this decade. They said probably 3 to 6% returns annually. So that's not terrible, but then again, you have inflation, which is, and I don't know if those were after inflation or before numbers. I didn't research it that well, but you probably have inflation that's running 2 or 3. So either way, that's not a tremendous return, and the economy had in prior decades been getting great returns. So we are going to stick with our historically proven formulas, which are high cash flows, defensive dividend stocks. Dividend growth and dividend stocks have outperformed over the 200 years of studies by other stocks by factors similar to 2 or 3 times. And it's very selected energy, REITs, and we're running out of time. But Nick, any last comments? We have about a minute or 2 left.
No, I think you just basically hit it on the head. But people, I think right now you need to make hay while the sun is shining, and the sun's shining right now.
Yes.
So you better start making money and start putting money away.
Yeah, that's great.
Diversified, because I don't see the next decade being very well. In other words, we're going to hit bumps.
No, I don't see very likely. Hopefully, President Trump's pro-growth policies will overcome this, and that's what. But I'm not optimistic that he can overcome 50 years of neglect. And
he's not even going to be around in the 2030s.
Well, that's true. We don't even know who the president of the Congress will be. There's just so much change. But you're right about that too. Put away what you can, make hay where you can, and be careful with your investments. So thanks for watching Wall Street Hackers. Have a happy holiday season, despite the fact that the economy might scare you a little bit. But keep working, make hay, as Nick said, As Kim always says, get healthy, get wealthy. We will see you in the new year around January 6th at 6 p.m. Eastern Standard Time. See you soon. Be well.